Shanghai, January 2026. The largest financial exodus in modern history just happened, and almost no one noticed. $5.8 trillion. Gone. JPMorgan, Goldman Sachs, BlackRock, the titans who built empires on Chinese growth, just walked away. Not slowly, not quietly, but with the precision of institutions who saw something the rest of us didn't. While you were checking your portfolio, while analysts were talking about recovery, the smartest money on earth was already out the door. And the door? It just slammed shut. This isn't theory. This isn't speculation. The money has already moved. For 2 decades, Wall Street preached one gospel. China is the future. Invest in China. Build in China. Bet everything on China. And they did. American pension funds, European hedge funds, sovereign wealth from the Middle East, they poured trillions into Chinese stocks, bonds, real estate, infrastructure. The narrative was bulletproof. 1.4 billion consumers. A government that could build cities overnight. Returns that made Western markets look like savings accounts. JPMorgan alone held over $800 billion in Chinese assets at the peak. Goldman Sachs had positioned itself as the bridge between Beijing and global capital. BlackRock, the world's largest asset manager with over $10 trillion under management, had called China its biggest growth opportunity of the century. Larry Fink himself flew to Beijing, shook hands with Communist Party officials, and promised his clients that this was the safest bet in emerging markets. Then, something changed. It started in the data, the kind of data most people don't read. Foreign direct investment into China dropped 37% year over year in late 2025. Not a slowdown, a collapse. Capital outflows from multinational corporations hit record highs. Companies that had spent decades embedding themselves in Chinese supply chains were suddenly restructuring. Apple began shifting production to India and Vietnam. Tesla slowed its Shanghai expansions. Semiconductor firms started building fabs in Arizona and Texas. But corporations move slowly. Financial institutions, they move at the speed of risk. By the fourth quarter of 2025, the sell-off had begun. Quietly at first, a reduction here, a rebalancing there. Portfolio managers don't announce retreats. They execute them. JPMorgan started unwinding positions in Chinese equities. Goldman reduced its exposure to yuan-denominated bonds. BlackRock, despite its public optimism, began rotating capital out of China-focused ETFs and into Japanese, Indian, and Southeast Asian alternatives. The total? $5.8 trillion. Withdrawn, redistributed, redeployed. To understand the scale, consider this. $5.8 trillion is larger than the entire GDP of Germany. It's more than the combined market cap of Apple, Microsoft, and Amazon. It's the kind of money that doesn't just move markets, it reshapes them. And when that money leaves a single economy in less than 12 months, it sends a message louder than any press release or policy statement ever could. The message? The China trade is over. Wall Street didn't make this decision lightly. These institutions had spent years lobbying for access to Chinese markets. They hired Mandarin-speaking analysts. They opened offices in Shanghai and Shenzhen. They navigated regulatory mazes that would have broken smaller firms. They believed, or at least they told their clients they believed, that China's rise was inevitable. So what changed their minds? Start with the obvious: geopolitics. The relationship between Washington and Beijing isn't just strained, it's structurally antagonistic. Trade wars evolved into technology wars. Technology wars became financial decoupling. The CHIPS Act didn't just subsidize American semiconductors. It declared economic warfare on China's tech ambitions. Export controls on advanced AI chips, restrictions on quantum computing technology, bans on Chinese telecom equipment, each move tightened the noose. But smart money doesn't react to headlines. It anticipates them. Behind the geopolitical theater, financial institutions were watching something more fundamental. China's economy was breaking. Not in the dramatic way economies collapse in movies. No bank runs, no hyperinflation. This was a structural fracture. The real estate sector, which had been the engine of Chinese growth for 30 years, was imploding. Evergrande defaulted on over $300 billion in debt. Country Garden followed. Dozens of regional developers went under. Ghost cities stretched across provinces, massive residential complexes built for a demand that never materialized. Chinese households had 70% of their wealth tied up in real estate. When property values started falling, consumer confidence didn't just dip, it evaporated. Retail sales flatlined. Domestic consumption, the supposed pillar of China's economic transition, stalled. The government tried stimulus, rate cuts, infrastructure spending, subsidies, but the money wasn't circulating. It was being hoarded or moved offshore. And that's when the numbers told a darker story. China's official GDP growth figures claimed 4 to 5% annually. But independent analysts, the ones Wall Street actually trusts, were seeing something closer to 1 or 2%. Some argued China was already in recession, but hiding it behind fabricated statistics. Provincial governments were cooking books to meet Beijing's targets. Banks were rolling over bad loans to avoid recognizing losses. The shadow banking system, worth trillions, was a black box of hidden debt and fictitious assets. JPMorgan's risk models started flashing red, not because of what Beijing was saying, but because of what the data wasn't showing. Credit growth was decelerating. Foreign reserves were being drawn down faster than reported. The yuan, despite capital controls, was weakening in offshore markets. These are the kinds of signals that don't make headlines. They make exit strategies. Goldman Sachs ran stress tests. What happens if China's growth stays below 3% for 5 years? What if the real estate correction turns into a decade-long deleveraging? What if Beijing's stimulus measures fail to reignite consumption? The models were unambiguous. Staying in meant absorbing losses that could wipe out years of gains. BlackRock faced a different calculation. As a fiduciary, it owes clients maximum risk-adjusted returns. When the risk in China started outweighing the return, when volatility spiked, liquidity dried up, and regulatory uncertainty became the norm, the math changed. Larry Fink can sell optimism to CNBC, but he can't sell negative alpha to pension funds. So they pulled the plug. But then the numbers told a darker story. 5.8 trillion doesn't vanish. It relocates. And where it relocated tells you everything about what Wall Street believes comes next. The capital didn't go back to New York or London. It went to Tokyo, Mumbai, Hanoi, Jakarta. It went into Japanese government bonds offering stability. It went into Indian infrastructure plays, betting on the next manufacturing superpower. It went into Vietnamese factories and Indonesian commodity plays. The reallocation wasn't random. It was strategic. Wall Street was preparing for a world where China isn't the growth engine, it's the risk factor. Markets reacted accordingly. The Shanghai Composite lost 18% in 6 weeks. The Hang Seng entered a technical bear market. Foreign ownership of Chinese equities hit a 15-year low. Even state-backed funds couldn't stabilize prices. Beijing responded with buying programs, media campaigns about resilience, and threats against short sellers. None of it worked. When institutional capital moves, retail investors and government intervention can't stop it. Currency markets told the same story. The yuan depreciated despite the People's Bank of China burning through reserves to defend it. Offshore yuan rates diverged from onshore rates, a classic sign of capital flight. Chinese corporations started issuing a dollar-denominated debt instead of yuan bonds, signaling their own lack of confidence in domestic currency stability. Behind closed doors, something else was happening. Central banks were watching. The Federal Reserve, the European Central Bank, the Bank of Japan, they saw the exodus and understood the implications. If China's economy was genuinely faltering, global growth projections had to be revised downward. Commodity demand would soften, trade volumes would shrink, deflationary pressures could spread. The interconnectedness that made China's rise so profitable was now a transmission mechanism for instability. The Fed started scenario planning for a hard landing in China, not publicly, not in FOMC statements, but in internal risk assessments shared with major financial institutions. What happens to global liquidity if Chinese banks face a solvency crisis? What happens to dollar funding markets if yuan devaluation accelerates? What happens to American exports if Chinese consumption collapses? These weren't hypotheticals anymore. They were contingencies. And that's when the illusion finally cracked. For years, the narrative had been that China and the West were economically interdependent, too intertwined to decouple, too reliant on each other to truly conflict. But $5.8 trillion just proved that narrative was always a sales pitch, not a reality. Financial institutions are not sentimental. They don't care about partnerships or historical relationships. They care about returns and risk. And when the calculus shifts, they move. The historical parallels are impossible to ignore. This moment echoes the capital flight from Latin America in the 1980s, when debt crises triggered a lost decade of growth. It mirrors the exodus from Southeast Asia in 1997, when currency collapses wiped out decades of development gains. It rhymes with the retreat from Russia after the ruble crisis in 1998. But this is bigger. China isn't a regional economy. It's the world's second largest. It's the largest trading partner for over 120 countries. It's the manufacturing hub for everything from smartphones to solar panels. When capital abandons China at this scale, the ripple effects don't stay contained. They cascade. Consider the commodities markets. China consumes 50% of global copper, 60% of iron ore, half the world's steel. If Chinese demand contracts, commodity prices collapse. Australia's economy, built on iron ore exports to China, faces recession. Brazil's mining sector takes a hit. African nations dependent on Chinese infrastructure investment see projects freeze. The entire commodity supercycle that fueled emerging market growth for 2 decades could reverse. Or consider the dollar. When investors pull out of yuan assets, they convert into dollars. That creates demand for the greenback, strengthening it against other currencies. A stronger dollar makes American exports more expensive, widening trade deficits. It makes dollar-denominated debt more expensive for emerging markets to service, triggering financial stress in countries already on the edge. The geopolitical consequences are even more profound. Beijing is watching its economic leverage erode in real time. For years, China used market access as a bargaining chip, threaten sanctions, lose access to Chinese consumers. But if foreign capital is already leaving, that threat loses potency. Xi Jinping's government is facing a legitimacy crisis. The Communist Party's social contract with the Chinese people was simple: sacrifice political freedom for economic prosperity. If prosperity fades, what's left? Some analysts argue Beijing will double down on state control, capital controls, forced repatriation of assets, nationalization of sectors. Others predict liberalization, opening markets further to lure back foreign investment. Both scenarios carry risks. Tightening control accelerates capital flight. Liberalizing invites instability. Wall Street isn't waiting to find out. The $5.8 trillion that left wasn't a warning shot. It was an evacuation. But what does this really mean for investors? If you're holding Chinese equities, you're swimming against institutional current. If your mutual fund or ETF has significant China exposure, you're absorbing risk that the smartest money just exited. If you're betting on a Chinese recovery, you're betting against JPMorgan, Goldman, and BlackRock, firms with more data, better models, and faster execution than any retail investor. That doesn't mean China will collapse tomorrow. It means the probability of negative outcomes has increased enough that institutional investors won't pay for exposure. It means the premium once attached to Chinese growth has evaporated. It means the market is repricing China from opportunity to liability. For the global economy, the implications are staggering. Supply chains are fracturing. Manufacturing is relocating. Trade routes are being redrawn. The assumption that globalization was irreversible is being tested. The belief that economic integration prevents conflict is being challenged. Could this trigger the next global reset? History suggests it could. The unwinding of major capital flows has preceded every significant economic realignment of the past century. The British Empire's decline began with capital flight from London. The Soviet Union's collapse was accelerated by the withdrawal of Western financing. Japan's lost decades started with a real estate crash and capital reallocation. China's trajectory may not mirror those exactly, but the pattern is familiar. Overinvestment, debt accumulation, asset bubbles, capital flight, prolonged stagnation. The difference is scale. China's economy is larger, more complex, more integrated into global systems than any of those precedents, which means the fallout could be larger too. Central banks are preparing, governments are positioning, corporations are restructuring. And the institutions with the most money, the ones who always know first, have already moved. $5.8 trillion doesn't lie. This is not the end of China. It's the end of the illusion that China's rise was linear, inevitable, unstoppable. It's the end of the fantasy that authoritarian capitalism could outperform democratic markets indefinitely. It's the end of the bet that geopolitics and economics could remain separate. What comes next is uncertainty, and uncertainty is expensive. For those paying attention, the lessons are clear. Watch where capital flows, not where headlines point. Trust data over narratives. Understand that the institutions managing trillions move faster and smarter than the news cycle. When JPMorgan, Goldman Sachs, and BlackRock all head for the exits at the same time, it's not a coincidence, it's a consensus. The global financial order is shifting. The winners of the next decade won't be those who cling to old assumptions. They'll be those who recognize the shift, adapt their strategies, and position themselves ahead of the crowd. This isn't just a market correction, it's a warning. The question is, who's paying attention? The money has spoken, now it's your move.